in fact, let's quickly take a look at what's happening as far as global equity action is concerned. Remember, as we mentioned, the Dow slumping something like 100 points as Brexit fears clearly seem to be re-emerging. So right now you're actually seeing a little bit of a mixed trading session, at least in Europe, where earlier in the day, remember, you had the pound that fell to a fresh 31-year low, especially after the Bank of England governor warned about how, you know, the near-term, at least, path for the markets was sort of fraught with uncertainty, and that's why you had the sterling getting pounded and actually swooning to a fresh 31-year low. Keep in mind, you're seeing a sharp slide in crude oil prices also. That's sort of contributing to the overall slump. Very quickly, Ajay, what's this latest catalyst for this, risk aversion that we've seen come to the fore?
Well, Tanya, two economic data. In fact, this next 1 week, 10 days will be fraught with a lot of economic data coming out of China and US, which global markets will react to. But two in particular, which have again raised global growth concerns: the China manufacturing data and similarly factory and defense data, which has come out for US markets. Both of these markets are very high on manufacturing, and the data shows weakness. And that is along with some of the unconfirmed reports of some large funds based out of Europe stopping redemptions. Some liquidity issues and fears of that liquidity issues are also doing the round as far as global reports are concerned. So this combination is making a lot of investors jittery, which we also need to take an account for.
Okay, let's bring on board then three special guests who are joining in to walk us through what they're making of the current cues both in the local and global markets. Amit Nigam of Peerless Mutual Fund. We've got Madhur Jha of Standard Chartered Bank, and from New York, Gurraj Singh, Sangha, who's a senior global macro portfolio manager, joins in on the phone line as well. All three of you, thank you so much for taking time out for us. Gurraj, let me begin by actually asking you about what's happening in your part of the world. You've of course had a trading off for 3 days, an extended weekend. This is the first time in almost 5 days that you've seen Wall Street open lower. What are these concerns that seem to have resurfaced? What's fueling it, you think?
Right. As Ajay mentioned, the manufacturing data from China and actually a few other regions of the world continues to indicate growing weakness, or at least a minimum an amelioration in strength. And also, what's happening in Europe is, the continued fallout from the Brexit vote. Particularly, there seems to be an increased number of funds facing liquidity concerns, and that's tending to reverberate through the market. And the U.S. market is picking up on that cue and also starting to weaken a bit. These things the Brexit fallout is probably going to take several months to fully digest into the markets, and in that interim, the trading is likely going to continue to be quite volatile.
Gurraj, I want you to tell us how exactly are the risks right now. Now that big rally happened last week, and some amount of profit taking is understandable, but the unconfirmed reports suggest that some of the large funds, mainly invested in real estate around Britain, are stopping redemptions, and some other liquidity concern may have emerged at other agencies. This is actually triggering some amount of panic or some amount of elevated concern that are we heading into a position like Lehman-like moment? Do you think that it's too much to jump to that kind of a conclusion and liquidity is not that tight in the region?
I think I've seen the analogy made, and from the way that I view markets as complex systems, I don't think this point in time is the appropriate moment for either a Bear Stearns or Lehman-type catalyst, which triggers a major fallout in global markets. I think what's happening is, by virtue of the vote that occurred with Brexit, there are many investors who are reassessing their involvement in Britain, and as one or two start to redeem their investments, it's just creating a domino effect. Now, what happened back then in terms of Lehman, there was a derivative issue, and the counterparties involved with derivatives never expected a major clearinghouse to fail. That situation doesn't exist at this moment. That type of situation is probably going to rise later, more due to sovereign debt. There's over 12 trillion in debt, with negative yields. Those type of issues, I think, will be the catalyst for a Lehman or Bear Stearns type movement, but later on, not at this point. But right now, investors are continuing to reassess their involvement in the UK, and on a wider scale, what is the impact for Europe? Because there's been a number of movements within, I guess, somewhat fringe political parties in Europe who've been looking for an opportunity to take their countries out of the European Union. For example, Italy and Spain, things of that nature. It's given a boost for those type of movements, and I think that creates a greater risk with respect to movement of capital out of Britain and out of Europe on a wider scale into the U.S. and other places. That I think is a much more tangible risk.
Gurraj, let me interrupt you there. In fact, I wanted to talk to you about it. Italian banks are the ones which took the big cut in today's session as far as the European markets are concerned. In fact, the financial stability report coming out of Europe clearly mentions that things are not very stable. That may have also spooked traders. How are you analyzing the commentary from there, and how badly is that region at risk of economic recession? The bond yields are also crashing there.
Right. The Italian banks for many months have continued to see weakness in their balance sheets, in part due to a continuing deflationary fallout from what's happened in Europe over the past several years. So they're in somewhat of a precarious situation, and the Italian authorities are essentially trying to circumvent current EU rules with respect to bailing out banks. So it's creating tension between the Italian government and the European Central Bank, and that on balance that's a negative. Those banks need help, and then a bailout is going to be required one way or another. And it's just a question of what form it takes, and that type of bailout will continue to weigh on the European currency. The secondary effect with respect to that is that many of the Italian banks, as well as banks throughout Europe, have loaded up on European sovereign debt because it's given a zero risk rating. When and if, which are going eventually there'll be a when the yields with respect to European debt start to rise, that will create increasing pressure on European financial institutions, and that will be sort of the second wave of a banking crisis, which will begin in Europe.
Let's get Madhur in on this discussion as well. Madhur, the other thing is, what you heard the Bank of England governor say today. He's warned of challenging risks to financial stability following the Brexit vote. Of course, he's also sort of kick-started that entire stimulus process. A lot of folks, in the markets are banking now on concerted central bank action. How much is it that central banks can actually do, you think, to sort of stem this volatility?
Well, clearly this is something which should have more of a political project, because this is all about negotiations between whichever new UK government comes into power and the European Union as to what the new relationship will look like.